My name is Charles Luo, Chief Investment Officer.
My name is Brandon Greer, Chief Risk Officer.
My name is Melanie Buckworth, Chief Compliance Officer and Director of Research. Hi, we are the executive team from Rotman. Our investment philosophy follows three broad pillars. 1. Deliver positive returns agnostic to broad market direction. 2. Manage factor exposures to capitalize on forecasts. And 3. Control portfolio volatility by limiting exposure to unintentional or idiosyncratic risks. What is a factor? Factors are investment styles that have the ability to deliver high returns over a long investment horizon. That being said, risk premiums come at a price, as factors can perform poorly over the short run. This can be due to macroeconomic disruptions like high inflation or slowed economic growth. So in order to attain the most value, factor investing often requires dynamic trading strategies. Dynamic trading typically involves taking both long and short positions in the portfolio and can include strategies like value growth investing, momentum, and short volatility. Some examples are going long stocks with low prices relative to fundamentals and shorting large market capitalization stocks as they traditionally have higher prices and lower excess returns than their smaller counterparts. It is important to note that proper construction of these portfolios should remove the market portfolio. In terms of research, our team utilizes statistical modeling to identify a broad universe of profitable factors that represent an economic exposure and allocate to a complementary portfolio of these factors that is expected to perform in both the near and medium terms. Our portfolio management team works to neutralize sector, idiosyncratic, broad market, and non-model factor exposures and ensures superior trade execution while minimizing costs. Our risk management team acts as a secondary audit of our portfolio management and further works to identify unwanted unmodeled exposures. Lastly, we utilize an evolutionary approach which involves reconstructing and rebalancing when there are material changes in economic environment or factor selections. Our research team uses a disciplined approach to portfolio construction and factor selection. We source factors on the following 4 premises. 1 is ensure the factors we look at are justified by academic research. 2, that factors exhibit significant premiums that are expected to persist into the future. 3, substantial return history so we're able to backtest these factors. And be implementable and in liquid and tradable securities. As always, our team reserves the right to change our views and outlook on any factors currently being deployed in the portfolio. In our first quarter composition, we used value, momentum, size, and quality factors. For value, we used both EBITDA to EV and free cash flow to price. For momentum, we used high minus low. For size, we used the log market cap. And for quality, we used the accruals ratio and the 1-year change in sales turnover. After considerable performance attribution, we adjusted our Q2 factors to remove log market cap and the high minus low, and added street consensus to quality, 1-month active return to momentum, active utilization to a short interest factor, and lastly, implied volatility on traded options. Now, I'd like to pass it to Charles to discuss our portfolio construction.
Thank you, Melanie. Team Rotman uses quantitative methods to select stocks from the Russell 1000 index. We rank our stocks based on our model, which consists of various quantitative factors. We select mid-range factors, so we would rebalance our portfolio every 3 months. The top decile of our rankings are held in the long portfolio. The bottom decile of our rankings are held in the short portfolio. We aim to have a portfolio of 100 stocks long and 100 stocks short. Then we optimize our portfolio based on our constraints. Initially, we weigh our stocks using inverse volatility weights. Our volatility is based on the last 120 trading days. This way, stocks are weighted based on their volatility contribution. Then we optimize our portfolio based on industry exposure and market beta constraints. As we would like to focus on our factors, we limit our beta to be less than 0.2 and industry exposure to be less than 20%. Now I will pass it on to Brandon to talk about performance and risk.
Thank you, Charles. As of February 7th, we've realized a return on our multi-factor quant portfolio of about 0.5%. Our annualized standard deviation is 1.59% and our downside deviation is 1.51%. Our holdings beta of about 0 indicates market neutrality, though we realized a beta of 0.77 through Q1, indicating that the portfolio did move with the market during the period. As the graph shows, our portfolio tended to rise and fall along with the market, but in a significantly muted fashion, which is also evidenced by our low volatility. In Q1, we allocated net long positions to industrials, IT, and real estate, with short positions in financials, utilities, and consumer staples. Our portfolio allocation is sector agnostic, and over the medium-term forecast horizon, we are comfortable with sector exposures that are consistent with our factor model. We believe that hedging sector exposures introduces trading costs, will drag on return without necessarily creating any diversification benefit, and that reweighting to neutralize sector exposures risks diluting our factor allocation. Our positive return was largely driven by our long positions, particularly in financials, IT, real estate, materials, and industrials. If our sector long was positive and our sector short negative, that would be because the sector performed well, like in real estate and IT, and if both legs perform well, like in materials and industrials, that means our factor model performed within that sector. When we reweighted factors in Q2, we did include some sector neutralization in our weighting process because we believe that our realized beta in Q1 was the result of our sector exposures. While we no longer have any large long or short sector bets, we do have large offsetting weights in financials, consumer, discretionary, and information technology, so we expect these sectors to be a large part of our Q2 return and volatility. Most of our factors also perform similarly to the market, with a correction in December and then recovery in early 2019. The accrual ratio factor, though, saw consistent positive returns, but the rest of our original model factors were negative early performers with a reversal in January. The factors we eliminated, log market cap and high minus low price, were consistent underperformers, and we've decided that we do not expect a future risk premium from these for Q2. Our major realized exposures by style were long financials and short size momentum in mid-cap, but we expect that our rebalancing should eliminate these excessive exposures. While single name stock picking is not part of our portfolio mandate, we do consider it important to be aware of and to manage idiosyncratic exposures. So our best performing positions were our longs in LPL Financial Holdings, Dentsply, Sirona, and McCormick & Company, and our worst performing positions were our shorts in 2 REITs and Biotechnicorp. Most of these names are healthcare related, which performed well in Q1. As of January 16th, our largest risk contributors and offsets are as shown. We calculate risk contribution as a function of the weight, independent standard deviation of the stock, and its covariance with the other stocks in the portfolio over the observed time period. So an offset should be a negative beta position where the market risk offset outweighs the idiosyncratic risk contribution of the stock. We did not hold any securities contributing excess volatility in Q1, and this is consistent with our inverse vol weighting strategy. Now I will pass on to Melanie, who will discuss compliance.
Thank you, Brandon. As Chief Compliance Officer for my team, I certify that the portfolio has remained in compliance with all regulations provided by the CQA. I acknowledge that violations of these regulations can result in the deregistration and termination of the fund. Specifically the following: concentration, 5% of the unlevered portfolio, both long and short; market neutral, no leverage, dollar neutral, and less than 5% of the portfolio value held in cash. This concludes our presentation. Thank you.